The stock market did not fail most people. Their operating system failed them. The market can double in a handful of years, and millions of people can still feel poorer, more anxious, and more behind. That is not a contradiction. That is a diagnosis. I have watched ordinary people walk into the market with the vocabulary of investors and the reflexes of gamblers. Then they act surprised when the machine takes their cash, their time, their confidence, and sends the rewards somewhere else. Wall Street has a crude name for that kind of participant: a capital donor. I do not care whether the phrase hurts your feelings. I care whether it describes your behavior. If you buy because the crowd is loud, sell because your stomach turns, chase because a stranger online sounds confident, and call that strategy, then you are not operating a portfolio. You are feeding a machine designed to reward discipline at the expense of impulse. That is the first thing you need to understand. The stock market is not a charity. It is not a classroom. It is not even fair in the way most people mean fair. It is a transfer system. It transfers money from the impatient to the patient, from the noisy to the silent, from the emotional to the rational, from the tourist to the owner. Most people enter that system with the wrong operating system installed. They think investing means prediction. It does not. They think success comes from being early to excitement. It usually does not. They think complexity is sophistication. Usually complexity is just expensive confusion wearing a suit. They think rich people win because rich people know a secret ticker. That is a child's explanation for an adult reality. The real difference is not intelligence. It is system design. You can see the proof in plain sight. A large share of Americans own stocks in some form. The broad market can rise dramatically, yet the gains concentrate. A small slice of the population ends up owning most of the market. That tells you something uncomfortable. Access is not the same as advantage. You can be inside the game and still be playing the losing role. That losing role begins with a simple error. You confuse motion with progress. You watch a stock move and feel informed. You refresh an app and feel engaged. You hear a story about artificial intelligence, energy, biotech, defense, crypto, or whatever the current religion happens to be, and you feel late. Then you buy relief, not value. You buy belonging, not ownership. You buy emotional anesthesia at the exact price. Other people are eager to sell it to you. Then panic arrives. The same crowd that sold you confidence now sells you fear. You dump the asset, lock in the damage, and tell yourself the market is rigged. The market is not rigged in the way you think. Your psychology is rigged against you because you never built an operating system strong enough to survive your own emotions. That is why ordinary people so often buy high and sell low, not because they are stupid, because their financial life is built on a fragile software stack. Their salary is linear, their expenses are sticky, their emergency reserves are thin, their time horizon is short, their conviction is borrowed, their information is secondhand. And when all that fragility meets volatility, they do the only thing fragile systems know how to do. They break. Now, I want to say something that many people in this business hate saying because it is too plain to be glamorous. For the average person, a boring operating system beats an exciting one. If you are building from the ground up, the first layer of a functional capital operating system is not genius. It is durability. That is why blue chip companies matter. Businesses with scale, brand, cash flow, and the ability to survive ugly conditions are not exciting cocktail party material. They are weight-bearing beams. Apple, Microsoft, Coca-Cola, and businesses of that class are not perfect. Nothing is. But they have an important quality that fragile people desperately need. They can keep working while the owner sleeps. That matters more than you think. A weak investor wants action. A strong investor wants machinery. The amateur asks, what can triple? The adult asks, what can endure? That shift alone saves people years of self-inflicted damage. But even here, ordinary people make another mistake. They touch one good idea and turn it into overconcentration. They buy one company, fall in love with the story, mistake familiarity for safety, and hand their future to a single management team, a single scandal risk, a single product cycle, a single regulatory mistake. That is not conviction. That is fragility dressed up as courage. This is why index funds and ETFs are such powerful tools for ordinary people. Not because they are sexy, because they allow you to buy slices of hundreds or thousands of businesses at once. They give you breadth when you do not yet have the time, skill, data, temperament. An emotional armor to build concentration intelligently. That is a grown-up decision. You do not need to prove brilliance with your retirement. You need to protect compounding from your own urge to be clever. Low cost matters, tax efficiency matters, automatic contributions matter, time in the market matters, consistency matters. A simple broad market fund inside a 401k, a Roth account, or another tax advantaged vehicle is not an insult to your intelligence. It is respect for mathematics. Most fortunes that ordinary people fail to build do not fail because the return was unavailable. They fail because the habit was unavailable. They stop, they interrupt, they improvise, they consume the seed, they pull the plant out of the ground every few months just to check whether it is growing. Compounding does not reward obsession, it rewards continuity. Diversification belongs in this first layer for the same reason a ship needs multiple compartments. Not because you want to avoid every wave, because you want one bad wave to stop being fatal. Some domestic exposure, some international exposure, some bonds, if your time horizon or stomach requires them, perhaps some real estate exposure through public vehicles. The point is not to create a magical portfolio that never feels pain. The point is to reduce the odds that one theme, one sector, or one country becomes your personal extinction event. Ordinary people often hear that and feel disappointed. They want a faster answer. There is a faster answer. Usually it is just a faster way to lose. Now let us move to the second layer, because this is where the operating system begins to separate. Millionaires often do something that destroys ordinary people. They buy individual stocks. Same action, different operating system. That difference is everything. The retail crowd buys narratives. The disciplined wealthy buyer studies businesses. The crowd buys because a chart moved. The disciplined buyer studies earnings power, capital allocation, incentives, durability, margins, valuation, and the probability that the business will be stronger in 5 years than it is today. The crowd wants social proof. The disciplined buyer wants asymmetry. The crowd wants to feel early. The disciplined buyer wants to be right. That is not semantics. That is the dividing line between speculation and ownership. When I buy a business, public or private, I do not ask whether it will impress strangers. I ask whether it throws off cash, whether management behaves rationally, whether the moat is real, whether the purchase price leaves room for error, and whether time is likely to work for me instead of against me. Most people skip that work because it is slow, quiet, and lonely. Then they call the result bad luck millionaires who survive. Do another thing ordinary people ignore. They protect capital as aggressively as they pursue returns. This is where many viewers get uncomfortable, because the fantasy they carry is pure upside up only. Win only, growth only, no friction, no sacrifice. Real capital allocation is not a fantasy. It is trade-offs. Look at a case like Mark Cuban after the Yahoo deal. He had enormous exposure. He understood something simple that the crowd rarely understands. A large gain can still turn into a catastrophe if it is left naked in a manic market. So he used an options collar. He paid for downside protection with a put, and he helped finance that protection by selling away some upside with a call. Read that carefully. He gave up part of the dream in order to keep the fortune. That is what adults do. Children ask, how high can this go? Adults ask, what happens if I am wrong? The wealthier you become, the more you realize that avoiding ruin is not conservative. It is offensive strategy. The game is not won by one heroic sprint. It is won by staying alive long enough for compounding to keep stacking. This is why I want you to stop romanticizing upside without insurance. You insure your car, you insure your house, you insure your health, then you leave your financial future naked and call that confidence. That is not confidence. That is amateur theater. Protection is not weakness. Protection is refusal power. When you have refusal power, You do not get forced into selling quality assets at humiliating moments. You do not become a hostage to panic. You do not spend every correction negotiating with your own fear. Now we move into dangerous territory because the next layer is leverage. Leverage is an amplifier. It does not improve judgment. It magnifies whatever judgment you already have. If you have $1,000 and borrow another $1,000, your gains can grow faster. Your losses can also become educational in the most expensive way possible. People hear stories about borrowed money and imagine acceleration. I hear borrowed money and ask a different question. What happens to the borrower when the market, timing, liquidity, and psychology all turn against him at once? That question saves careers. Leverage is not evil. It is unforgiving. Used by a disciplined operator with liquid reserves, appropriate sizing, and a deep understanding of risk, it can be useful. Used by an insecure person trying to outrun mediocrity, it is gasoline on fear. That is why I do not want ordinary viewers confusing millionaire tools with beginner tools. A chainsaw is useful. It is also a terrible first knife. A lot of wealthy people understand that their own time has a higher value elsewhere. They are running companies, managing teams, making acquisitions, negotiating deals, building brands, or operating capital in businesses. They understand better than the public market, so they delegate part of the public market game. That is where hedge funds enter. But let me simplify this before the jargon fog arrives. A hedge fund is not magic. It is a specialized operating unit. It hires talent, data, models, and systems to pursue returns in ways most individuals cannot. Some funds buy and short, some trade event-driven situations, some make macro bets on currencies, rates, commodities, and global imbalances. Some build quantitative systems that notice patterns too small or too fast for a human being to exploit consistently. Bridgewater looks at systems. It asks how inflation, policy rates, debt, and global relationships ripple across markets. Renaissance turned code, statistics, and pattern recognition into a machine so effective that it became legendary. You should not hear that and think, I need to become a quant genius by Friday. You should hear that and understand a brutal truth. The market contains industrial scale competitors. While you are staring at a message board, someone else has physicists, engineers, satellite data, execution speed, risk models, and a team paid to do nothing except find tiny edges at scale. That means your edge cannot be pretending to be them. Your edge has to be where they are weak, and you can be strong, patience, simplicity, long duration, low cost, clear rules, emotional stability, selective concentration only when earned, self-control when nobody is clapping. That is why many ordinary people lose. They choose the wrong arena. They bring a kitchen knife to an industrial war and then blame the battlefield as capital grows. Another layer appears: coordination. This is the layer most people never see because it happens behind closed doors. The billionaire does not merely own assets. He operates an integrated wealth machine. That machine has investors, it has analysts, it has tax lawyers, it has estate planners, it has legal strategists, it has people who think about what to buy, how to hold it, how to finance against it, how to shield it, how to transfer it, how to harvest losses, how to reduce tax drag, and how to preserve control across decades, not quarters. That is a family office. Do not reduce that to a fancy concierge service for rich people. It is more important than that. It is a private command center for capital. At this level, the operating system stops being portfolio management and becomes life architecture. Now, private equity makes sense in that architecture, buying into private businesses, financing growth before public markets ever see the story. Backing founders early, taking over companies outright, or participating in value creation before the crowd gets access. That is not just stock picking. That is position building before the public re-rating. Jeff Bezos had access to Google early. Peter Thiel had access to Facebook early. Elon Musk had access to Stripe early. Those are not lottery tickets in the way ordinary people imagine. They are networked opportunities unlocked by capital, credibility, and access. That word matters. Access. The wealthy do not just buy better assets. They gain access to different opportunity sets. This is also where tax strategy stops being a side note and becomes a compounding engine. Most people think taxes are just the bill you pay after success. The wealthy understand taxes as a leak in the operating system. Plug the leak and the machine compounds harder. Ignore the leak and you spend decades working for the government before you finish working for yourself. Tax loss harvesting sounds technical, but the logic is simple. If one position went up and another position went down, you can realize the loss to offset the gain and reduce the drag. That keeps more capital inside the machine. Ordinary people often hold losers because hope is emotionally easier than discipline. The professional operator asks a colder question: is this asset still the best use of capital after taxes, after opportunity cost, after information, after the alternative? If the answer is no, sentiment does not get a vote, then you reach one of the most revealing strategies of the ultra-rich: buy, borrow, die. Most people hear that phrase and react morally before they react strategically. I understand the instinct, but if you want to understand how wealth behaves, you need to look directly at the mechanism. If you own a highly appreciated asset and sell it, you may trigger a large tax bill. If you keep the asset, borrow against it at a manageable rate, and live on the proceeds or redeploy them, you can unlock liquidity without turning the gain into a taxable sale. Then at death under current rules, the basis can step up for heirs. That is not how poor people think, because poor people do not have the collateral base to play that game. Again, different operating system. Same world, different rules. And before you start worshiping this layer, let me stop you. There is danger in staring at billionaire behavior the way children stare at race cars. You see the speed and miss the engineering. You see the finish line and miss the thousands of design choices that keep the engine from exploding. Trying to mimic the endgame without building the base layers first is one of the stupidest habits in finance. You do not need buy, borrow, die if you cannot hold a broad market fund for 10 years without touching it. You do not need private equity access if you still carry credit card balances at ruinous rates. You do not need option collars if you do not even know why you own the stock. You do not need a hedge fund if you are not maximizing the simple tax advantaged accounts already available to you. You do not need to think like a billionaire if you still behave like a tourist. This is where I need to press harder, because many viewers secretly want complexity as an excuse. If the answer is simple, then the responsibility is yours. If the answer is boring, then the discipline is yours. If the answer is patience, then the discomfort is yours. A lot of people would rather hear about quantum trading models, satellite imagery, private rounds, collars, basis step-up rules, and hidden tax channels, because those things make their own inaction feel sophisticated. But the truth is more brutal than that. For most people, the wealth gap in investing is not created by lack of access to exotic tools. It is created by failure to master ordinary tools for an extraordinary length of time. They never install the right base operating system. They never automate. They never study enough to earn selective concentration. They never protect downside. They never separate entertainment from investing. They never stop consuming signals from people with no consequences. They never convert salary into ownership with religious consistency. They never build the internal scorecard required to stay calm while everybody else is losing their mind. And then they wonder why they keep funding someone else's compounding curve. Let me make this even plainer. There are really several capital operating systems stacked on top of one another. The first is the survival OS: stop donating. Stop trading your future for dopamine. Build an emergency reserve. Eliminate toxic debt. Use tax-advantaged accounts. Buy broad, low-cost exposure, hold, repeat. The second is the ownership OS: study actual businesses. Read filings. Understand valuation. Know why a company earns what it earns. Only then earn the right to concentrate. The third is the protection OS. Hedge when exposure becomes life-altering size positions. So you can survive error, treat ruin as the only outcome you must never negotiate with. The fourth is the amplification OS. Use leverage rarely, carefully, and only when you understand exactly what can go wrong, how fast, and what backs the position when conditions turn ugly. The fifth is the delegation OS. When your time or scale justifies it, outsource specialized tasks to specialists, but never outsource judgment about incentives, fees, or risk. The sixth is the Dynasty OS coordinate taxes, estate planning, philanthropic transfers, private deals, collateral strategy, and succession, so the machine survives you. Now here is the uncomfortable part. Most people live their whole life trying to cosplay the fifth and sixth layers while never mastering the first. They want hedge fund returns on a household budget held together by overdrafts. They want private deal access with public market discipline they never develop. They want the billionaire tax conversation without millionaire asset discipline. They want the status of wealth without the software of wealth. That is the trap. Rich people do not merely own more assets. They run a different system of incentives, information, behavior, and control. They are not always smarter. They are not always better, but they are often more systematic. And the market pays systems. Another thing you need to understand is that investing usually is not what makes someone rich first. This point matters because it corrects a fantasy that wastes years, businesses, concentrated ownership, equity in something that grows, the sale of a company, unusually valuable labor deployed wisely. Early access to opportunities and disciplined saving often create the base. Investing then preserves, scales, and organizes that base. That is why I tell people that public market investing is one of the best tools for building wealth slowly and one of the best tools for preserving wealth at scale. But it is not a substitute for becoming economically useful. If your income engine is weak, your investment engine starves. If your savings habit is weak, your investment engine sputters. If your spending is performative, your investment engine leaks. If your attention is broken, your investment engine gets hijacked by noise. The market cannot rescue a life built on bad incentives. This is also why the emotional side matters more than people admit. A bad investor is not just someone who picks the wrong stock. A bad investor is someone who cannot sit still, someone who cannot say no, someone who needs constant stimulation, someone who confuses volatility with risk and boredom with failure, someone who wants to tell people what he bought more than he wants to understand what he owns, someone who would rather be seen as smart than become rich slowly. That personality pays an invisible tax every year. I call it the applause tax. It is one of the most expensive taxes in the world because it never arrives as a bill. It arrives as foregone compounding. You buy what is fashionable, you abandon what is functional. You chase what is loud, you neglect what is durable, you optimize for status instead of control. And by the time you notice the damage, a decade is gone. I want you to build the opposite, a silent operating system, a system that keeps buying productive assets while you are busy living, a system that does not require constant prediction, a system that treats tax drag, fees, panic selling, unnecessary turnover, and lifestyle inflation as enemies, a system that respects boredom because boredom is often where wealth is actually built, a system that understands that the point of money is not to perform for strangers, it is to increase your control over time, decisions, and dignity. Even philanthropy looks different when you understand the operating system properly. When very wealthy people donate appreciated stock instead of cash, they can avoid capital gains and still receive deductions. That can serve both charitable outcomes and tax efficiency. Again, do not stare at the public gesture and miss the machinery underneath it. The wealthy often do not move capital in the form that is most obvious. They move it in the form that preserves optionality. Optionality is another word you should tattoo on your financial mind. The poor person is forced, the fragile person is rushed, the over-leveraged person is cornered. The wealthy person, when operating well, preserves choices. He can wait, he can refuse, he can hold, he can borrow, he can donate, he can harvest, he can redeploy, he can survive bad timing because his system was designed to absorb pressure. That is why the real subject here is not stocks, it is control. Stocks are just one battlefield where control becomes visible. So where does that leave you? It leaves you with a decision that most people postpone for years because postponement feels painless. You can keep running the default operating system, consume first, save what is left, chase stories, react to prices, call emotion conviction, outsource your thinking to crowds. Pretend that access equals skill, pretend that activity equals progress, donate your capital to people with better systems, then complain that the game was unfair. Or you can install a different operating system. You can decide that from this point forward, every dollar of income has a job before it has a temptation. You can decide that low-cost, broad ownership is your base, not because it sounds grand, but because it works. You can decide that you will not buy a business. You cannot explain. You can decide that you will study before you concentrate. You can decide that you will stop worshiping upside and start respecting survival. You can decide that fees, taxes, panic, and ego are not minor annoyances. They are extraction mechanisms. You can decide that if you ever use advanced tools, you will earn them layer by layer, not borrow them as costumes. You can decide that your portfolio will stop being a mirror of your impulses and start becoming a machine for freedom. That last word matters most. Freedom does not begin when you are rich enough to own a family office. Freedom begins when your operating system stops sabotaging you. Freedom begins when you stop needing every market move to validate you. Freedom begins when you can let a productive asset sit there and work without turning it into a daily referendum on yourself. Worth freedom begins when you stop donating capital through noise, ego turnover, taxes you failed to plan for, leverage you did not understand, and concentration you did not earn. That is the real line between the crowd and the wealthy. Not money first, behavior first, system first, then money if you want the harsh truth. Here it is. You do not rise to the level of your hopes in markets. You fall to the level of your operating system. And every year you delay installing the right one, you are not standing still. You are compounding the wrong thing. That is the door in front of you. On one side is the default life, more noise, more prediction, more excitement, more donations to better operators, more years spent calling motion progress. On the other side is a colder, quieter path: save, own, hold, study, protect. Scale only when earned, build optionality, keep more of what you make. Let time become your accomplice instead of your enemy. You do not have to be born rich to choose a second path, but you do have to stop acting like the first one is harmless. Because it is not, it is expensive, it is corrosive. And if you keep running the wrong operating system long enough, the market will not merely fail to make you rich, it will turn your working life into fuel for somebody else's machine.